Morning, GWB. So I decided to take today off to pretty much deliver this morning's briefing and also to answer a few questions that I've received recently and also give my thoughts on the outlook of the market, in particular with small to mid cap stocks and even probably mega caps, all right, going forward. So the main outlook or the main news for today is the Fed will be meeting at 2 p.m. ET today. All right. So they're expected to give their views on their tapering, which is the widely used term for slowing down monthly purchases of government-backed debt. So there's been a lot of arguments saying that this has been the reason why the markets have continued higher. You know, it's been intervention from the Fed. So they have already indicated many times that they expect to reduce the amount of support they're giving to the economy and also of the purchases of government-backed debt. And if that is to begin to slow, then that's an indication that, the economy is doing well. The economy is doing good. That's my understanding of it anyways. And it says here that Jerome Powell will also give us a talk after the conference. And it will, people will be looking for hints at when and how officials might begin to pull back that economic support that we spoke about. But if he decides that they won't be pulling back, then obviously that will be seen as a negative in some sorts, because again, if the Delta variant, which a lot of people are talking about, there's a lot of concerns regarding the growing numbers, that if the Fed were to pull back and the Delta variant numbers will continue going higher, then obviously how is the economy going to be able to support itself, especially when other places, certain cities in the US are locking down again. How are they going to have that support if the Fed are pulling back that support? However, if the Fed don't pull back that support, then it's seen that the Fed thinks or the Fed believes it's going to get worse. So it's pretty much a lose-lose, all right, is what I'm saying. It's a lose-lose situation, I think, because people are not blind. They're looking at the statistics. They're seeing that this is the US COVID cases stats. And as you can see, it's on the rise. It's on the rise. So we are not blind. Investors are not blind. Wall Street is not blind to the number of cases rising again. So if the Fed pull back that support, how is the economy going to support itself? If the Fed do not pull back that support, then the Fed see this as getting worse and out of hand and have to continue to support the economy. So both cases or both outcomes of today seems like it's going to be negative, and potentially the market will react how it wants to react. All right. So the market has been really weird. It's been very fearful regardless. It's been very uncertain. We're seeing we're starting to see more articles now saying, the Delta variant could make the American shopper go back into lockdown, the BOFA says. And, the writing's on the wall, in my opinion, the writing's on the wall. Now, what does this mean for the market going forward? I think plain and simple, it's going to continue either in this consolidation for most of the mega caps and probably a further decline in small to mid cap stocks, as we've already seen. As the S&P 500 PE ratio corrects itself. I was sharing this in the HIMS chat yesterday evening that we are now finally heading in the right direction. Okay, so I recorded a YouTube video back in March, saying that, look, this is bad news for stocks. All right, that's what I titled it. I said bad news for stocks. The S&P 500 ratio, we were at 40 at the time. And, if you go back and watch that video, I was saying, since the turn of the decade, the new range is from the turn of the decade is between 20 and 30. As you can see from the 1800s, from 1880 up until 2000, the range was between 10 and 20. But since the turn of the decade, it was much higher. So the typical range where you can say the S&P 500 isn't overvalued is probably between the ranges of 20 to 30. All right. And it was at 40 at the time. And, 3 or 4 months later, we are heading in the right direction, but we are not at that level where you can consider the S&P 500 to be valued or undervalued, at least definitely not undervalued at the moment. So we're now at 34. All right. So I believe we have to see this number head towards the low 20s before we can start to see the arguments that the S&P 500 is fairly valued again. And, we might start to see a bullish run. But up until then, I believe We're going to continue to consolidate sideways, for the next month, for the next couple of months, up to a year, maybe 2 years, until the valuations catch up with itself. Because as you can see, last year we absolutely took off. We had a crazy bull run last year, and everything is pretty much slowing down, and we are heading downwards, which is a good sign. Now, what does this mean? It means we have to continue to be patient. All right. Don't buy every single dip that you're seeing. All right. You need to be patient. And you need to be strategic with your buying. All right. The market can remain irrational longer than you can remain solvent. And this is so applicable in this scenario right now, where we're seeing companies, report incredible earnings. I mean, look at Teledocs, right? So Teledocs came out, they had 109% year over year growth to $503 million. Absolutely insane growth, but yet not good enough in this market. It's down minus 7.35%. You had Apple. Again, Apple had one of the best quarters in their history. Yesterday they reported it, and after hours it's down 1.43%. And it's probably going to continue going lower. You had Tesla. Again, Tesla had an incredible quarter. It's just not good enough in this market. The market is overvalued, and therefore even fantastic earnings, it doesn't matter. It just doesn't matter until the S&P 500 ratio starts to get into undervalued territory again. All these earnings, it doesn't matter. Now, if a company was to report poor earnings, or maybe not smashing earnings, then we're going to see results like Teledocs minus 7%, and so on and so forth. And I believe this will continue for the rest of this year, to probably throughout next year. It's more than possible. But I will be keeping an eye on the S&P 500 ratio. If we start to enter the low 20s, then that's a good sign. But up until then, it's just going to continue to be boring, slow, sideways, probably downtrending within that period of time. And I don't really know what more to say. That's just the reality of the situation. Now, I've had this discussion with many Discord members, saying that, look, if you've invested in money that you need now, or you need in the short term, this is going to be a horrid time for you. It's going to be a horrid time for you. But if it's money that you don't need now, then you buying strategically on the way down is essentially building your wealth in the long term. Okay, so for me, people ask me, did I buy Tattooed Chef yesterday? Let's pull up Tattooed Chef, because we've jokingly said that if Tattooed Chef drops below 20, we should buy the dips. So it was at 19 yesterday, and I didn't buy. I didn't buy because I'm being strategic. I'm using the Fibonacci retracement levels to time my buys. So my next buying of Tattooed Chef will probably be at $18.50. Let me quickly pull up the Fibonacci retracement. Okay, this is the Fibonacci retracement levels for Tattooed Chef. So yeah, I'll be nibbling again at $18.79. And I plan to nibble some more at $17.31. And then at 15, if we do ever see 15 again, which is highly possible in this current market, if we are going to go sideways or downwards for the next year or so, then, I'll continue to load the boats at these levels. And this is what I plan to do for pretty much all of my major positions, and any new positions that I do decide to start. I'll just use the Fibonacci retracement tool. And if you're not familiar with how to plot this, we've already done a video lesson on it in the Discord. Let me pull it up and I'll show you. Learn it. All right. Learn it, because this will help you time your entries and time your buys more efficiently. All right. So if you check the latest live video lessons, it was done with K. I did it with K. Yeah, it's called How to Use the Fibonacci Tool to Set Entry, Exit, and Buy Levels. Make use of this content, guys. This is invaluable content. All right, and we recorded it for a reason. So make use of it. So you're not just buying every single dip. Any dip that comes, you're buying this, buying that. Before you know it, you're gonna run out of money. You can't buy every single dip. It's not possible. All right, so make use of these levels here to time your buys, and that will just get you through this rut, get you through this boring period within the market. And eventually you're building your wealth on the way down, and then you'll benefit on the way up when the market normalizes and then continues higher. So yeah, that's today's morning updates. I hope you guys have a great day, and I'll see you in the Discord. Peace.